Hello, Jake. I hope you're doing well today.
Hi Emma, I'm great, thanks. What are we learning today?
Today, we're diving into some economics and finance vocabulary.
Sounds interesting. What specific terms will we cover?
We'll explore terms like fiscal, monetary, quantitative easing, recession, and austerity.
Wow, those sound significant. Are they hard to understand?
Not at all. I'll explain them through conversation. Let's start with fiscal.
Okay, what does fiscal mean?
Fiscal relates to government revenue and spending. For instance, fiscal policies impact taxation.
Got it. So it's about money management by the government.
Exactly. Now, let's move on to monetary policy. It involves controlling the money supply, right?
That makes sense. But how does that affect people like us?
Good question. It affects interest rates, which can influence our loans and savings.
So if interest rates are low, borrowing becomes cheaper?
Yes, and that's where quantitative easing comes in. It's a monetary policy to stimulate the economy.
Quantitative easing. How does that work?
It involves the central bank buying financial assets to increase money supply. It encourages lending and investment.
I see. And when would a country use that?
Typically during a recession to boost economic activity.
Recession, right? That's when the economy shrinks, isn't it?
Correct. It's marked by declining GDP, higher unemployment, and lower spending.
So, during a recession, people might save more because they fear losing their jobs?
Exactly. And then, to deal with a recession, governments might implement austerity measures.
Austerity? What does that entail?
Austerity involves reducing government spending to control debt. It's quite unpopular with the public.
I can imagine. Reducing spending sounds tough during hard times.
It is. Now that we have a good introduction, let's explore these terms further in a dialogue. Jake, what do you think about the recent fiscal policies in the UK?
I think they're trying to balance the budget, right? But aren't they facing criticism?
Yes, some people feel that cutting spending during a recession is not the best approach.
That makes sense. Austerity can lead to a lot of hardship for citizens.
Exactly, especially when public services suffer from budget cuts.
What about monetary policies? Are they more flexible?
Monetary policies can be adjusted more easily, yes. Central banks can change interest rates quickly.
And quantitative easing? I've heard it mentioned but never really understood how it works.
Quantitative easing serves to increase liquidity in the economy, especially during tough times.
So, the central bank buys assets to pump money into the economy then?
Exactly. This encourages banks to lend more, stimulating investment and spending.
But isn't there a risk of inflation with that approach?
Definitely. If too much money chases too few goods, inflation can increase.
It's like a double-edged sword then. What would you suggest as the best approach?
A balanced approach is key. A mix of fiscal discipline and monetary flexibility might work best.
That's insightful. So, how important is public opinion in these matters?
Very important. Policies often depend on public support to be implemented effectively.
Thanks for clarifying these terms. It's really making me think about economics differently.
I'm glad. Let's dive in a bit deeper with another scenario and see how these terms interact. Imagine a country facing a recession. What strategies should it employ, Jake?
Well, I'd say they probably need to use quantitative easing to stimulate the economy, right?
Good thinking. That can help encourage spending, but they can't ignore fiscal responsibilities.
So they should balance stimulus with austerity measures to manage their debt?
Exactly. Too much austerity can slow recovery, so a careful balance is essential.
And during this, they'll also need to communicate effectively with the public, I imagine.
Absolutely. Transparency helps build trust during difficult economic times.
Do you think monetary policies can be effective on their own then?
They can be, but fiscal measures often create a more comprehensive approach.
What about inflation risks? Are they greater when a country implements both?
Potentially, yes. If monetary easing is too aggressive without fiscal control, inflation can rise.
So it's a delicate dance between stimulating growth and controlling inflation?
That's a perfect way to describe it. A delicate balance is essential for economic stability.
I never appreciated how interconnected these terms are until now.
I'm glad you're seeing that. This understanding is essential for financial literacy.
What are the key points to remember about each term?
Good question. Let's summarize them clearly in a vocabulary section. Fiscal relates to government spending and revenue, essential for economic management. Monetary policy is about managing the money supply through interest rates by the central bank. Quantitative easing aims to stimulate the economy by increasing liquid cash through asset purchases. A recession is a period of economic decline, marked by reduced economic activity. Austerity involves strict measures to reduce government spending and control national debt.
Those definitions really help. Can we see examples?
Of course. Here are some example sentences for each term. First, fiscal. 1. The government needs to improve its fiscal management to ensure a balanced budget. 2. Increased fiscal responsibility can lead to long-term economic stability. 3. The fiscal deficit has grown larger due to reduced tax revenues. Next, monetary. 1. The central bank's monetary policy decisions directly affect interest rates. 2. Strong monetary policy can help curb inflation. 3. Changes in monetary policy can have rippling effects on the economy. Now, quantitative easing. 1. Quantitative easing was introduced to stimulate the economy after the financial crisis. 2. This policy filled the financial system with additional liquidity. 3. Many argue that quantitative easing can lead to asset bubbles. For recession. 1. The country entered a recession following the economic downturn. 2. Many businesses closed during the recession, leading to high unemployment. 3. The recession prompted calls for stimulus measures to revive growth. Lastly, austerity. 1. Austerity measures have led to public protests in several countries. 2. The government implemented austerity to reduce its national debt. 3. Critics argue that austerity worsens economic conditions during a downturn.
These examples clarify the terms well. Let's move on to a quick review.
All right, Jake. Here are some practice questions. 1. What does the term fiscal refer to?
Fiscal refers to government revenue and spending.
Correct. 2. How does monetary policy influence interest rates?
It's managed by the central bank to control the money supply.
Exactly. 3. What is quantitative easing intended to achieve?
To stimulate the economy by increasing liquidity.
Great. 4. Can you explain the effects of a recession?
A recession leads to declining GDP and higher unemployment.
Spot on. Lastly, 5. What are the risks associated with austerity measures?
They can lead to public dissatisfaction and worse economic conditions.
Excellent work today. You're really grasping these concepts well.
Thanks, Emma. This lesson was enlightening. What's next on our agenda?
Next time, we'll explore different types of investments and their risks. Looking forward to it.
Me too. See you next time.
Goodbye, Jake.